This is a presentation on adjustments to income. It corresponds to the material covered in Lesson 6 of the 2024 Self-Study Counselor Training and Certification course. Now, references for data covered are publications 4012, tab E, and publication 4491, Lesson 17. Now, the topics we'll be covering in this lesson are educator expenses, alimony paid, traditional IRA contributions, and student loan interest paid. As a reminder, adjustments can be used to reduce the amount of income that's taxable. So first are educator expenses. The taxpayer must be a K-12 teacher, counselor, principal, or aide. They can deduct up to $300 of qualified educator expenses per year. If the tax return is a joint return and both taxpayers are teachers, they can deduct up to $600, but neither can deduct more than $300. Teachers from public and private schools can claim this deduction. They must have worked in a school for a minimum of 900 hours during the tax year. The deductions can be claimed for classroom materials, professional development supplies, including personal protection equipment. Now, professional development expenses are allowed unless reimbursement is offered by the school but not accepted. Alimony granted by the courts prior to 2019 is considered income by the recipient, which we covered in our discussion on income. Alimony does not include child support. Now, the payer must provide the Social Security number of the recipient. The payer qualifies for an alimony adjustment against income made during the tax year. Alimony set up under a court decree after 1984 and before 2019 is grandfathered, meaning it remains in place, although the tax laws dealing with alimony payments changed on January 1st, 2019. Now, the payments continue to be deductible by the payer. Alimony received by a taxpayer continues to be includable income by the recipient as compensation for IRA purposes. So if a taxpayer received $4,000 in alimony, that taxpayer can contribute up to $4,000 to an IRA, even if they had no other income. Now, see the section titled, How Do I Handle Alimony Paid, in Lesson 17 of publication 4491 for more information. So again, the tax treatment of alimony changed after December 31st, 2018. Prior to the end of 2018, the payer of alimony could use it as a deduction from income. The receiver of alimony was required to claim it as income. After December 31st, 2018, alimony paid was no longer deductible by the payer and no longer income for the receiver. In addition, alimony received could no longer be considered compensation for IRA purposes and could not be used to make IRA contributions. Now, modifications made after December 31st, 2018, to a court decree issued prior to that date must specify if the new rules are intended to apply. If a court decree modifying the original agreement does not specify that the new rules apply, the old rules regarding payer deductions and recipient income remain in place. We discussed IRA distributions in a prior lesson. Now we're going to focus on IRA contributions and how taxpayer contributions are treated tax-wise. There are two main concepts to consider when working with IRA contributions. The first is allowable contribution. That's the yearly limit on the amount that can be contributed to an IRA. Second is the allowable deduction, which is a limit on the deductible amount that can be taken as an adjustment to income on a taxpayer's return. Now, TaxSlayer, the software we use, will correctly limit the deduction. TaxSlayer does not, however, check the contribution amount, so excess amounts that are contributed by the taxpayer are simply treated as non-deductible. So two main concepts: allowable contributions limits yearly amount contributed to an IRA. That's both traditional and Roth. The lower of earned income or $7,000, it's $8,000 at 50 or over. Be sure the combined Roth and traditional IRA contributions don't exceed the contribution limit. Allowable deduction, It limits the deductible amount taken as an adjustment to income. Amount depends on income and filing status. It's all calculated by tax layer. Roth IRA contributions are not deductible. Now, allowable contributions can never be more than taxable compensation. W-2 income, self-employment income, which we'll learn about later, and grandfathered alimony count as allowable compensation. Interest, dividends, pensions, scholarships, unemployment, Social Security, and rental income are not considered compensation for IRA contributions. On a joint return, both spouses can combine their compensation for total allowable contributions. Contributions can be made to either spouse's IRA. Contributions can be divided between accounts in any amount, subject to the maximums allowed. Now, a non-working spouse is eligible to make IRA contributions provided the working spouse earns enough to cover all combined contributions. So if each spouse contributed $5,000 to an IRA, the working spouse would need at least $10,000 in qualifying compensation. There are no longer any age limits for taxpayers wanting to contribute to a traditional IRA. The age limit was 70 and a half, but that restriction was eliminated after December 31st, 2019. Now, Roth IRAs have never had an age limit. IRA contributions for the current year can be made up until the April filing deadline on the following year. That gives taxpayers a few extra months to maximize contributions. Now, if a taxpayer files for an extension, which normally can go up until October 15th, the taxpayer does not get an extension on time to contribute to the prior year's IRA. And speaking of years, the taxpayer needs to make sure the trustee of their IRA is well aware of which year their contributions are intended for. So if they make a contribution in, let's say, March of 2025 and intend that contribution to be for 2024, they better make it known, or else the trustee will treat the contribution as counting toward their 2025 IRA. Student loan interest. If a taxpayer pays more than $600 in student loan interest, they should receive a Form 1098-E. If so, we just input the numbers in the form. If the taxpayer did not receive a Form 1098-E, they can just tell us the amount of interest they paid and we can enter it. Be sure to remind the taxpayer that in all cases where we're taking their word, they should be ready to provide the government with proof of any interest paid. Now, proof could include things like bank or credit card statements. So the maximum adjustment allowed is $2,500 per year. The adjustment is not allowed for taxpayers with a married filing separately filing status. Now see the student loan at a glance chart, which can be found in Publication 4012, tab E on page 17. Now that concludes our discussion on adjustments to income.